Today, our group, Rahman, Imran, Keith, and myself, will present our investment strategy using technical indicators to drive trading decisions. Our presentation will describe the demographics of the ideal investor and explain what technical indicators are and the different types utilized. We will then describe our trading strategy based on the rules and parameters of the technical indicators we chose to work with. After, we will display the historical backtesting process and results to verify the profitability of our trading strategy. Finally, we will explain the advantages of our trading strategy, its relation to behavioral finance, and summarize our results. The investor we're looking for is ideally a middle to middle upper class investor between the ages of 30 and 40 with disposable income. The investment strategy will have a medium to short term time horizon and does not require the investors to constantly monitor their investments and the market all day long. The investors using our strategy suffer from a lack of self-control and commit errors using emotional shortcuts. For example, they may trade emotionally and buy shares of a company after it has run up a lot, when in reality, it was overbought and they did not do their proper due diligence. Investors using this trading strategy will not be subject to emotional errors or lack of self-control, as the trading strategy has specific rules when to buy or sell a security. The ideal investor is looking to limit their risk while aiming to maintain market returns.
Thank you, CJ. In this part of the presentation, I'll be discussing some popular technical indicators. The first one is simple moving average. Simple moving average uses a determined time period to calculate the average of the selected data, which is usually the closing prices. This is very useful when determining if the trend will either continue or reverse. One of the more popular technical indicators is the MACD indicator. The MACD indicator consists of three components: the MACD line, the signal line, and the histogram. The MACD line measures the momentum between two moving averages, and then the signal line is an exponential moving average line of the MACD line. Finally, there's a histogram, which measures the difference between the MACD line and the signal line. As shown in the graph, when the MACD line crosses above the signal line, investors see it as a sign to buy, versus when the MACD line crosses below the signal line, investors see it as a sign to sell. Another way to visualize this is the histogram. When the histogram is positive, it is seen as a buy signal, and then when the histogram is negative, it's seen as a sell. Another popular technical indicator is the Bollinger Bands. It has three components: the upper band, the moving average, and the lower band. Bollinger Bands rely on standard deviation, which measures the volatility, and usually the upper and lower bands are about 2 standard deviations away from the moving average. The fundamental concept of Bollinger Bands is known as the squeeze. The squeeze occurs when two bands become closer together and they gesture a period of low volatility. Therefore, when the stock prices touch the lower band, investors see it as buy mode, versus when it touches the upper band, investors see it as sell. Finally, the last technical indicator that we will be discussing is RSI, or Relative Strength Index. RSI, according to Fidelity.com, is a momentum oscillator that measures the speed and change of price movements. The price oscillates between the values of 0 and 100, where when it's above 70, it is seen as overbought, and then when it's below 30, it is seen as oversold.
Thanks, RJ. Trading style. We use long-only strategy within an active style of trading. In a long position, the maximum you can lose is your initial investment. In addition, the market naturally wants to go in upward direction. This style is suitable for investors who have full-time jobs and do not have time to watch the market minute by minute. Besides, the shorting strategy through borrowing and selling is much riskier than going long, as the losses are unlimited. In addition, investor will need to be able to exercise a trade before market closure on the day the technical indicator recommends a buy. Furthermore, our strategy is not a day trading strategy. Only one trade is made each day to avoid any pattern day trade violations. Investment opportunity. For simplification in our strategy, we'll buy and sell entire position. Our strategy also assumes the orders are made close to the end of the trading day, since we are using adjusted closing price in our historical backtesting calculations. We will not enter a position until the first buy signal is given. The idea here is to minimize downside risk. We have decided to apply our strategy to ETFs with a high liquidity to allow us to get in and out of the trade within 2 days if needed. We are targeting SPY, an ETF which tracks the S&P 500. This also helps us to reduce the idiosyncratic risk. Here's now my colleague Keith, who's going to talk about empirical analysis.
Thank you, Imran. We chose to use several of the most common technical indicators, along with their parameters, to run our testing. These indicators include simple moving average, a 50-day and 200-day, MACD, RSI, and Bollinger Bands. Formulas were created based on when the indicator recommends to buy or sell. If we look at the chart on the right, we can see these parameters in action. In areas where the RSI is trending upwards above the lower threshold of 20, having just been below it, we see an opportunity to buy. Historical backtesting was completed using Microsoft Excel. VBA scripting was leveraged to import daily stock market data from Yahoo Finance. For reference, there are plenty of other platforms that can be used for backtesting, such as R and even several trading platforms. TD Ameritrade's Thinkorswim software makes use of their ThinkScript, which makes it very easy to test strategies and implement in real time. We chose to use Excel for its simplicity and portability since everyone has access to it. All returns will be compared to a benchmark, which is simply buying and holding. We use the Sharpe ratio as a measure of risk. The higher the Sharpe ratio, the greater the returns per unit of risk. The 13-week Treasury note was used to approximate the risk-free rate. Now let's take a look at the empirical results. The only two technical indicators to achieve better returns than the buy and hold strategy were simple moving average, the 50-day, and the MACD. However, the last technical signal was a buy, so the positions are still being held during the end date, meaning returns could increase or decrease. The SMA 50 results in a total return of 17.2%, which is on par with buy and hold, and MACD results in 19.1%. With Sharpe ratios of 2.628 and 2.876 respectively, both these strategies also offer our investors less risk. Although the buy and hold strategy yielded better returns than some of the other technical indicators, some of those indicators also had a better Sharpe ratio, indicating less risk. Here we can see the charts for our backtesting. The first row is the ETF's price, the second is the technical indicator, and the third is the backtested returns. If we look at the first set of graphs on the left, we see MACD. What's interesting here is that right before the market tanked from COVID, the MACD signal confirmed a sell, helping our investors avoid substantial losses. We see this on the green equity curve as a flat line. Then, the MACD issued a buy signal close to the market bottom. RSI, on the other hand, failed to identify the impending market crash and incorrectly issued a buy signal right before the crash. I should note here that we've programmed the backtest to ignore a sell signal if the strategy is not currently holding the stock and vice versa. The backtesting assumes we're not holding positions before the start of the test. The last chart on the right is the 50-day moving average. On the top right chart, we see the 50-day moving average, which is the green line, does not cross above the blue price line until after the COVID crash. However, issues a sell shortly thereafter, followed by another buy in succession. The bottom right chart shows the green equity line keeps our investor out of the COVID drop. Now, CJ will take us through some advantages of the strategy.
Our strategy is for investors who suffer from poor emotional shortcuts like hope, fear, and greed, and a lack of self-control because of their poor reliance on the intuitive, fast-thinking System 1 thought process, and thus may be subject to overtrading or reactionary trading, perhaps taking positions too late after a run-up they missed, or selling too early out of fear during a downturn, both of which result in underperformance or losses. Our investment strategy helps combat this behavior by relying on the reasoning in System 2 thinking to examine prior empirical evidence and deriving trading rules from the research for investors to follow. This takes the investment decisions out of the hands of the investors and removes the emotional and self-control issues from their trading. Finally, investors who use mental accounting should allocate the amount of their capital to our strategy based on the specific account they are trying to fund or the timeline necessary. For example, a college tuition fund that may be accessed soon can begin to allocate some of its funds to our strategy to get similar market returns with less risk. The behavioral wants portfolio pyramid on the left is layered by risk of the asset and its effect in behavioral portfolio theory. The least risky assets, cash, insurance, and Social Security, are for those who are loss or risk averse and want protection from falling into the lower social class. The next tier, bonds and gold, is associated with maintaining your social class and is a little more risky, but less compared to the higher third tier containing real estate, stocks, mutual funds, and commodities, and the higher fourth tier comprised of the riskiest call options, lottery tickets, and lottery-type stocks. Investing in the fourth tier is associated with goals to move up in social class, but may result in large losses. Since our investment strategy deals with stocks, it resides in the third tier of assets where investors are looking to maintain their social class. Although our strategy is subject to similar risks as the market overall, it is a little less risky than investing in the market portfolio, as demonstrated by its Sharpe ratio.
Thanks, CJ. Let me briefly summarize what we have been talking about over the last 10 minutes. Since our investors have a full-time job and do not have time to watch the market every minute, thus we designed the strategy using technical indicators to make profitable trading decisions. Furthermore, we adapted an active trading style that uses a long-only strategy applied to ETFs to minimize the idiosyncratic risk. Compared to benchmark, our strategy realizes less risk demonstrated by the higher Sharpe ratio. According to behavioral finance theory, we assume our group of investors tends to make emotional errors using System 1. This strategy eliminates that and allows for better trading decisions. Based on our research, we came up with the following recommendations. As a rule of thumb, one should not invest haphazardly. Rather, the investment should be a rule-based approach without the emotional influence of greed and fear. Our backtesting result shows this is a viable strategy. When trading SPY, we recommend using MACD and moving average to eliminate emotional errors. We recommend establishing a logarithm to implement the strategy in real time. And finally, we recommend only risking 5% of your account value to limit the risk. Although backtesting results were successful, past performance is not always indicative of future results. Further analysis is required to assess the performance of the strategy on individual securities. Thank you for watching.